Welcome back to Navigating Retirement. I'm your host, Rick Durkee. Hey, as we head into the end of the year, it's important to be aware of some tax planning deadlines. Tax reform is a hot topic in Congress. The proposed changes are all over the place. Some are good, some are bad, but no one can say for sure what they will do until 2022. Don't wait until it's too late. It isn't too late now to make some decisions. Be aware of these deadlines and take steps to lower your tax bill now. Regardless of what Congress does, we can be proactive with our tax planning and squeeze in some opportunities now before year end. Today, we'll discuss 4 critical strategies that could help you avoid common tax pitfalls in 2022 and beyond. So stay tuned. As always, lots of valuable information is coming your way.
Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. The firm only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability.
Welcome to Navigating Retirement with Rick Durkee.
This retirement planning video is meant to be shared. Share it, please, with anyone that might find it helpful. If you think that your retirement-minded friends or family might be interested in watching this video, feel free to just pass it along to them. There are also several links below in the show notes section with valuable information that you can use in your retirement planning journey. Take advantage of them. When you see a phone number, when you see a book, when you see an offer, give us a ring. We'll send it to you. All right, let's talk about the top 4 year-end tax planning ideas and management deadlines that help you navigate some of retirement's most important financial topics. What I'd like to ask you first, though, before we start, is asking questions sometimes give us the right answers? Certainly it does. Let's ask a lot of questions today and let's get our thoughts rolling and let's try and come up with some solutions here. The first topic is required minimum distributions. They are abbreviated, and the acronym for required minimum distributions are RMDs. Now, if you are currently 72, you have to start taking your required minimum distribution. That means you're taking distributions from your IRAs. You don't have to take distributions from 401ks while you're still working or any of the employer-sponsored plans, but you do on your IRAs. So there's some tax planning that goes along with this. But the key point here is required minimum distributions are something that we have to plan on that are going to affect the bottom line in our tax return once we turn 72. What are the current RMD rules? Well, there's factors that are applied to you. At different ages, those factors change. In other words, what happens is they require more to come out of that IRA, they being the IRS, so that you can spend the money, but they can tax it. Now, it's important that you pay attention to the RMD rules because if you don't take the money out, the IRS is going to slap you with a penalty that's 50 cents on the dollar. I can think of a lot better things that I can do than paying half of my money to the IRS because I didn't take out my required minimum distribution. So make sure you call us 843-735-5065 and you get that taken care of. Okay. How can I reduce RMD's tax effects on my IRA accounts? Well, there's a little thing called Qcds, another acronym. Let's talk about that in just a minute. Let's talk about Roth conversions for a minute. How do Roth conversions work? Basically, what you do is you pay taxes on IRA dollars right now, and then you move it over into or transfer it directly into a Roth account. That Roth account then will grow income tax free. So let's make sure that we're doing proper tax planning. We're doing proactive tax planning. And we're looking how to get that tax man out of the picture with our IRAs that are forever taxed, as Ed Slott shared with us in a past episode, and move them into accounts that are never taxed. You do pay the taxes now, but I bet you that tax is going to be less today than it will be in the future. Is a Roth conversion right for you? Might take a 3-step review to determine that. We may have to take a look at a past tax return or two and see what a projection of the next couple years' tax returns look like, and see if we can build a plan for you here at the Coastal Financial Planning Group to move things out of that IRA, pay taxes on the money now, and then move it over into a Roth, but making sure that we're not putting you into the next tax bracket with that decision. What's a backdoor Roth? Important question. We need to make sure that we understand that you can take money, put it into an IRA. If you're still working, you can contribute that money into an IRA as of today's tax laws, and then you can convert it to a Roth. That's a backdoor Roth. Because there are contribution limits on what you can put into a Roth, this way you can put money into an IRA, you can roll that money in over years, and then you can take it out through the Roth. Definitely tax forward planning, definitely something you should call us about here at the Coastal Financial Planning Group. Now, I mentioned a minute ago QCDs. What are some of the tax benefits of QCDs? QCDs are qualified charitable distributions. What you basically do here is you make sure that your custodian that's holding your IRA, when you have to take out your required minimum distributions, pays that money directly to a charitable organization. That will save you buku dollars on your tax return. You definitely want to do some plans for that. What qualifies as a qualified charitable distribution? And how do you make sure you're doing it right? Again, make sure that those monies are going custodian to the eligible charity directly. Don't take that IRA payment and then you write the check to the charity. There's some other things that we want to touch on here today. Contributions to your employer-sponsored retirement accounts. There are limits on what you can put in. We have a table that we can provide you. Look down in the show notes. We'll make sure and provide you that table that you can add some additional money to your employer-sponsored plans before year end, if you're within that window of opportunity that you can. That's something that you definitely want to give us a call right shortly on, because we're running out of time here on the year end. Are there advantages to participating in employer-sponsored retirement plans? Certainly. You reduce your income. That means less in taxes now. But remember, you're creating a big taxable account. So you might want to move some of that money out into a Roth. Hey, as a quick wrap up here, the U.S. Congress has been debating several bills that contain tax changes, and many popular tax planning strategies may go by the wayside. But it's not too late to take care of yourself and take advantage of year-end steps to lower your tax bill for next year. Regardless of what Congress does, we can always do things to avoid taxation. Remember, we never want to evade taxation, though. Learn how to lower your tax bill next year by taking a few vital steps today. Our team of experts at the Coastal Financial Planning Group is here to help you navigate the uncertain, changing landscape of tax laws this year and beyond. We'll work with you to develop a comprehensive financial plan that accounts for your unique personal and financial situation. Retirement planning is a very personal thing. There isn't one way to do it. Everyone is different, and people have their own goals and needs. We'll sit down with you, talk about your goals, and then help you come up with the best plan to get you there. Start planning with your future today with a complimentary 3-step review where we'll review taxes, your income plan for retirement, and also what risks you could avoid. Call us at 843-735-5065. Retirement is that big step in life, one that shouldn't be taken lightly, and most of the decisions we make are irreversible. So let's make them right. It's never too early, never too late to start planning your retirement and navigate through your retirement plan. Thanks as always for watching Navigating Retirement. I look forward to seeing you again in a future episode.
Catch more of Rick Durkee and Navigating Retirement by visiting cfpgroup.biz.
While we believe the information in this broadcast is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investment advisory services are offered through Fusion Capital Management, an SEC-registered investment advisor. SEC registration is not an endorsement of the firm by the Commission and does not mean that the advisor has attained a specific level of skill or ability. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Third-party rankings and recognition from rating services and publications do not guarantee future investment success. Working with a highly rated advisor also does not ensure that a client or prospect will experience a higher level of performance. These ratings should not be viewed as an endorsement of the advisor by any client and do not represent any specific client's evaluation. Generally, ratings, rankings, and recognition are based on information provided by the advisor. Please contact the advisor for more information regarding how these rankings and ratings were formulated.